Happy evening, everyone. Happy afternoon, everyone. This is CA Rahul Gandhi, Indirect Tax Chairman on behalf of Karnataka State Chartered Accountants Association. I welcome CA Ramesh, sir, who is a resource person today, who will be guiding us through how do we navigate this tax season. During the finalization of books of accounts, we all very often look into Companies Act perspective and income tax perspective and miss out to check on few crucial aspects from GST perspective. Since GST ka compliance is done in November, December, this process is dragged on. To this session is to cater these small and medium practitioners who face this issue and give them a power pack knowledge session. This is the first program which we are conducting. What do I say? Outreach program, I would name it as, with the Andhra Pradesh and Telangana Tax Practitioners Association. I have sincere gratitude to President CA Hitesh and their full team who has been very supportive of this initiative. With this, I would like to pass it on to President CA Hitesh to take it forward.
Thank you, Rahul. I'm audible?
Yes, sir. Yes.
Yes. So, good afternoon, everybody, all the participants. Hope we are able to, hope there are no technical glitches as of now. And I am Hitesh Jain, President of Telangana and Andhra Pradesh Tax Bar Association. Just for the information of members, we are an organization which has been established in 1970. That is in the undivided Andhra Pradesh. So we cater members from across Andhra Pradesh and Telangana. So this idea of a joint program was formulated in the past committee of KSCAA actually. So I even congratulate the new committee and the new office bearers which have taken over the organization, and we are also hopeful for more such joint programs maybe. And if you see, it's a Sangam today actually, because we are from Telangana and Andhra Pradesh, you are from Karnataka, we have spoken from Tamil Nadu. So obviously it's a Sangam, and hopefully we'll have such more programs. So since it is tax audit season, we humbly apologize if you are wasting your time also, but just 2 minutes will take. This session of GST aspects was not having an intention of some like only GST session. We had an intention of mixing GST aspects with accounts audit and tax audit report, because this is the need of the hour today, especially for the young members. So that was the intention behind it. Hope you like the program also. Prospectively will come to know about it. We will be open to the feedback as well. So I'll just pass it over to Rahul again. Thank you. You are on mute, Rahul. You are on mute.
Yeah. Thank you, Hitesh, for that. I would like to introduce CA Chandrasekhar to take it forward and introduce our resource person today, who is well versed in his field, so that members know and take the most out of this session.
Yeah, very good afternoon. Thank you, Rahul, for the opportunity. This is CA Chandrasekhar Vemula, Secretary of AP and Telangana Tax Bar Association. So it's my proud privilege to introduce today's speaker. He is graduated in economics from Vivekananda College, Chennai in the year 1978, qualified in November 82 and commenced practice in early 1983. Currently a partner in SRBR and Associates LLP. Passed the Information System Audit exam conducted by ICAI in September 2002, scoring All India 10th rank. He was empaneled as a peer reviewer with the peer review board of ICAI. He has presented papers on bank audit, accounting standards, auditing and assurance standards, and peer review at several CPE seminars organized by SIRC and branches. He has presented papers at seminars organized by Chamber of Commerce. He has contributed articles in CA Journal and SIRC newsletter, contributed content to publication of GST and Indirect Tax Committee of ICAI. He has co-authored a book on bank audit. He was a member of the Chennai One Financial Reporting Review Group. He is a co-opted member of the for the year 24-25 for the Committee on Career Counseling of ICAI. voluntarily, it's a really great service that voluntarily is a blood donor, A1 plus. Till now, till 22, has donated blood more than 40 times in the last 12 years. Friends, it's a great privilege to have the speaker. He's none other than our today's speaker, C.A.S. Ramesh Garu. Ladies and gentlemen, please join your hands and welcome today's speaker, C.A. Ramesh Garu. Sir. Over to Rahul.
Thank you so much, C. Chandrasekhar. It was very good to know, sir. Now I would like your technical expertise to take over the session, Ramesh, sir. You enlighten us with your experience and your knowledge so that we all benefited and serve our fellow clients and fellow professionals in a much better way. Thank you so much. I hand it over to Ramesh.
Shri Gurubhyo Namaha. Salutations to all my gurus, without whose help and guidance I wouldn't be what I am today or where I am today. Let me first thank C.A. Hitesh, C.A. Chandrasekhar, C.A. Rahul, and C.A. Sachin for having me here for this webinar, and also for the nice introduction by Mr. Chandrasekhar. I've been in this profession for almost 41 years, 42 years, and it's something which, these kind of webinars is the only way where we get to understand the nuances that we might otherwise miss out. Just give me a minute. Let me start the session and start the PowerPoint and then continue with it. 1 second. Can you see the PowerPoint?
Yes, sir.
Yes, sir.
Yes, sir.
So, as rightly pointed out by the two people who introduced me and the welcome address, this is a webinar where I think we need to focus on how to find out impact of GST on the accounts which we otherwise normally would miss out. As rightly pointed out, we tend to concentrate on Companies Act, compliance with Companies Act and compliance with Income Tax Act, but we don't look at GST compliances as much as we should look at, because the due date for filing of 9 and 9C is much later than the tax audit report, and therefore we tend to miss it out. In fact, I would have loved it if the government of India had said, first file your 9 and 9C, and then your tax audit report, and then your company law ROC filings. But that's not the way the law has been framed. The law expects us to do the company's account first, and then the tax audit, and then the GST audit. This was probably okay as long as the GST did not come into existence, but with GST having come into existence and literally touching every line item in the profit loss account and the balance sheet. In fact, I would be bold enough to say that other than cash on hand and bank balance, I think literally it has an impact on every other line item, including share capital sometimes. So I think we need to look at how we spot those items which have an impact on which has the GST impact, and how to make provisions for it, pay it, claim it, or whatever. So with that in mind, let's go into the session. I will first be starting with the books of accounts, wherein we look at the balances in the books of accounts and certain ledgers, how they should agree with certain ledgers or registers in the GST portal. If they do not tally, then we need to have a reconciliation statement prepared, which is very similar to a bank reconciliation statement that we do, which will highlight the reason for the difference between the books of accounts and the GST portal, balances in the GST portal. We will then move on to the financial statement itself, which is the main area of focus. I am going to be focusing on the financial statements, probably looking at very many ledger accounts to see whether this will have an impact on the GST or not. So I will highlight how we need to look at each one of those items. And then we'll move on to the tax audit report. Certain clauses in the tax audit report have a GST. We will look at that, which I will also be drawing reference to even as we are looking at the financial statements. We'll probably spend a little time on the Tax Audit Quality Review Board. I'm not sure how many of us have actually read the Tax Audit Quality Review Board's observations. I want to spend a little time there for the simple reason that unlike FRRB, where only financial reports of companies which are listed are picked up for scrutiny by the FRRB board, or a peer review where, unless you have a certain minimum number of partners, you don't have to go through a peer review. Tax Audit QRB can pick up the tax audit report of even the smallest auditor in the smallest city in India, according to their charter. So I think we need to be a little careful when we do a tax audit report. So we will spend a little time, not too much of time, but we'll spend a little time on tax audit quality review board, and then look at the year-end adjustment and their impact on the GST. Also look at cross charges and finish with verification of returns and reconciliations. Having pointed out all the topics that I intend to cover in the next 1.5 hours, you will notice that I did not say anything about one box in the extreme left corner, top this thing, which is SA 700. Why am I bringing Standards on Auditing 700 into a webinar which talks about GST impact on the financial statements and its relevance to tax audit report? I am bringing this in for a very simple reason that SA 700 is the basis of any audit report that we sign, whether it's a company audit report or a tax audit report. Unfortunately, again, I don't think most of us have gone through SA 700 in toto to understand that it applies also to a tax audit report. In fact, if you look at the guidance note given by the Institute of Chartered Accountants of India on tax audit, and also the publication of the Tax Audit Quality Review Board, they have emphasized that you need to ensure that your tax audit report is in tune with SA 700. So therefore, I will probably spend a few minutes there before we move on to books of accounts. As you all know, audit is an independent examination, and the audit report issued by you, me, or any of the big four, or any of the big firms in the country, or the big four in the world, are exactly the same in every respect, including a comma or a full stop. Nothing changes. But the crux of the matter that we're giving a true, whether we are certifying that it gives a true and fair view in conformity with the accounting principles. This is what an audit report is expected to give. But if you look at the tax audit report, we are certifying that it gives true and correct. It's no longer true and fair. It's only true and correct, which means every particular statement in 3CD we're saying is correct. There cannot be a mistake there. When we see true and fair, there is the concept of materiality. It's only we are not saying every figure there is 100% correct. But when we are certifying 3CD, we are saying that every figure there is correct. And to that extent, it's a very onerous task. If you look at part 3 of Form 3CB, again the same thing. We are saying that the said accounts read with notes gives a true and fair view, which means the financial statement are true and fair view, but 3CD is true and correct. And to that extent, I think we need to be very, very clear about what we put in our tax audit report. Similarly, in 3CB also, it's the same paragraph 3 of Form 3CA. There's no change there. While the financial certificates is a statement of non-corporate, which we certify and make it as a part of our tax audit report, we are certifying as true and fair, but the 3CD is true and correct. At this juncture, I would also like to draw a reference to or pose a question. If it had been live seminar, I would have waited for a response. But being a webinar, I will pose the question and also give an answer. How many of you get your 3CD signed by the auditee before you sign it? In various seminars that I attended, I attended as a faculty in the last 1 month on tax audit, the response was less than 5% of the members were gathered there. A 3CD is not prepared by us. Let's remember that very clearly. The 3CD is supposed to be prepared by the auditee and given to us. Just like the financial statement was supposed to be prepared by them and given to us, the 3CD is also supposed to be prepared by them and given to us. Maybe we do, sometimes we do prepare it, but that's outside the question. The question is, the 3CD is expected to be prepared by them, and we are expected to verify it and then certify it. So please do get the signature of the auditee in the 3CD before you sign the 3CD and upload it in the portal. Even the fact that he is approving it after we upload it in the portal is a different matter. Again, I wouldn't want to dwell into it because of the public platform, but most often than not, the DSC of the auditee is also available only in the Chartered Accountants Office, and from there it is levied. Tomorrow, the auditee can take a stand that I do not know anything about it because I did not do anything with it. That will put us in a risk. Therefore, the Institute also recommends that you should get your 3CDs signed by the auditee before you actually upload it. The SA 700, forming an opinion on auditors on the financial statements, talks about what should be the contents of an audit report. It says there should be an addressee, there should be an auditor's opinion, basis for the opinion, there should be a going concern. If the going concern is affected, there should be a paragraph on that. Key audit matters, other information, responsibility of the management for the financial statements, auditor's responsibility for the financial statement, other reporting requirements, and so on and so forth. Now coming to the tax audit report. Do we have in the tax audit report any paragraph regarding responsibility of the management of the financial statements and auditor's responsibility for the audit of the financial statements? Unfortunately, we do not have. These are the two key paragraphs that are missing from a tax audit report. And Institute of Chartered Accountants of India is very clear that any audit report signed by a member of the institute must have these two paragraphs. And therefore, we need to ensure that this is also made a part of the tax audit report. Paragraph 13.10 to 13.12 of the Guidance Note on Tax Audit revised 2023 talks about this. They say it are required to be filed online in the form in line with the requirements of SA 700. There is no specifically allocated field for providing the information. Also, they agree that the portal does not allow you to have any specific ways where it can be uploaded. But then how do you do it? Can we change the format? Are there technology limitations? Yes, there are technology limitations. But I think that again, we can rely on the institute to give us the guidance on this. They have told us where it should be inserted, how it should be. The next two slides are not very important. They are just the management responsibility paragraph and the auditor's responsibility paragraph. I will be sharing this presentation after this meeting is over, the webinar is over, both the associations, and they can choose to forward it to the members who have attended the seminar. If somebody wants to have a ready-made auditor responsibility paragraph and a management response paragraph, it's available. If somebody wants it in Word format, all they need to do is write to me. My email ID will display at the end of the webinar and I will send it to them. So these are nothing. But then where do we put it in? Where should it be disclosed? Again, paragraph 13.1 to 13.12 of the ICA says it is suggested that these respective responsive paragraphs can be given in the space provided for giving observations, etc., under clause 3 of form 3CA or clause 5 of form number 3CB, as the case may be. To be very honest, let me be honest and tell you that till about 2020, March 31st March 2020, we did not have these two clauses in the tax audit report. But once we read this in the tax audit quality review board's observations and also in the guidance note, we started putting this in. We have a standard format printed out with our seal, and whichever part of the uploading, he will initial it, and it is made as an annexure, and a reference to it is drawn in clause 3 of form 3CA or clause 5 of form 3CB. I would only request every member who is attending the seminar to ensure that it's done, because tomorrow, if something goes wrong, and today anything can go wrong, anybody can complain to the institute, and I don't know whether I'm right in saying it, but we seem to be the punching bag of the society at large. For anything and everything that goes wrong, the first person who is blamed is the chartered accountant, and therefore we need to be extra careful to see that there is no letter from any regulator, including the disciplinary committee of the Institute of Chartered Accountants of India, calling us for an explanation, and therefore let's put that in. Having said something about the management or an auditor's responsible paragraph, I again want to ask the question whether a tax audit report can be revised. Is there a necessity to revise the tax audit report, and can it be revised? The institute again says it should not normally be revised. However, a member may be required to revise the report on the grounds listed in the screen. That is revision of account by a company, change of law, which are the retrospective amendment, change in interpretation, example, CBT surplus judgments, any other reason. I'm unable to understand the third and fourth reason the institute has given. Change in law or a retrospective amendment. Excuse me. But if you do have to revise, you need to look at SA 560, which is subsequent events taking place, and be in line with that. Although the institute talks about certain conditions under which it can be revised, the Income Tax Act and rules itself has been reframed to allow a revision in tax audit. And we need to look at that. Rule 60 of the Income Tax rules was amended with effect from 1/4/2021 by insertion of a sub-rule, where it gives you a scope to file a revised tax audit report. And the logic is very simple. We have to file the tax audit report before the end of this month. A provision for bonus has been made. And the audit says, look, I will pay the provision only at the time of Diwali, which occurs in October. Why should I pay it in September? And the return itself is due only in October. While the tax audit report is to be filed this month, the return is only to be filed next month. And therefore, he has time till next month end to pay the bonus. But while I filed the tax audit report now, I will not allow that because it has still not been paid and I do not have evidence. Therefore, I will only show it as a disallowance. But since he has paid it before the filing of return, we need to file a revised tax audit report, which we will do next month after he produces the evidence that he has paid. And this has come into effect from 2021. Income tax rules itself is modified. Therefore, we can revise the tax audit report if we need to. But if we have made a mistake in the original tax audit report and we are trying to revise it, I don't know whether that is right, but the scope of revising it till 31st of October is definitely there. As I told you, I've taken 5 or maybe a little more than that for the SA 700 because I thought it was a matter of very grave importance, which somebody, I think Rahul pointed out, there are several young members who are attending this program, and therefore, for their benefit, I did bring it in. And now let's move on to the subject proper. We will compare the ledger accounts in the books of accounts with the corresponding GST returns. Your ITC ledger account in your books of accounts will have to jive with your credit ledger. If it does not, there may be several reasons for it, but have all those reasons been listed out? Has the reconciliation statement been made? And have you arrived at, yes, I'm satisfied with the reconciliation that the auditor has given me. The reason for the difference has been properly explained before you complete the audit. Excess cash paid in it, if any. It happened to us in one of our tax claims. Instead of paying 10,000 rupees, 1 0 went extra, and therefore he paid 100,000 rupees. That was lying in the cash ledger account, which should have been actually shown by the accountant of the company in a separate account in the GL, but it was not shown. We had to look at it, and then we had to find out where it had gone. He had debited it to rates and taxes, whereas it should have come to the ITC cash, GST cash paid account, and we had to rectify that. Those kind of things can happen because let us all remember that most of us do audit of micro and small, not even medium. And these auditees or entities have people as accountants whose knowledge of accounting is rather poor. And for us to look at the mistakes they have made, call out those mistakes and make those corrections. TDS GST. The TDS GST will again appear in the cash ledger in the portal, whereas in your books you may have an account called TDS GST in your ledger. We will certainly look at a little more on TDS GST as the webinar progresses. But these are the ledgers in the financial book which will jive with the GST ledger. GST liability in the financial books, which is GST payable or SGST payable, CGST payable, IGST payable, or one account, whichever way you are maintaining it, it should jive with just GS3 TB. ITC refund receivable account in your ledger should tally with the refund application status with the amount, same amount there. And then finally, your turnover or GST liability should correspond with your credit and liability statement in the portal. Now, electronic credit ledger, why should there be a difference between the electronic credit ledger and the ITC in the books of accounts? The minute somebody sells goods from, let's say, Delhi to Chennai on the 28th of March or the 28th of January, he will raise the invoice. It will appear in my 2A and 2B. But I have not received the goods. I have received the goods only in the next month 10th. Therefore, I can take credit in my ITC for ITC in my books only on the condition are fulfilled as per the GST Act, which says you should have received the goods or the services. You should have a valid invoice with you. Since I have not received the goods, even though I might have a valid invoice, since I have not received the goods, I cannot take credit for it till I receive the goods, which is probably the 10th of next month. And therefore, there can be a mismatch between the ITC as per books and the credit ledger. There are several other reasons why there could be a difference. We need to be very clear about these differences, list it out, have it as a reconciliation statement, and then move on. There are several reasons why a turnover as per books and the value of outward supply will not match. Let us look at a few examples. We are now looking at revenue recognition with the GST turnover reconciliation. Again, as I said very clearly, I mean, in an example just a minute back, I have invoiced the goods on March 28. However, the risk and reward has not passed on. The risk and reward passes on according to the terms of contract between the seller in Chennai and the buyer in, let's say, Karnataka. Only when it reaches the Karnataka buyer's godown or factory, which may take 4 or 5 days' time. Till then, the risk and reward are not passed on. And according to my accounting standard, revenue recognition, I cannot recognize the revenue this year. I can only recognize it next year. In a situation like this, if I de-link it from my turnover for the year because of the accounting standard, then you need to look at it. Normally, what we do is if there are only a delay of 2-3 days, we take cognizance of the fact that the events occurring after balance sheet date and continue to recognize it. But if there's been a long delay, if it's an export and it is not reached, and the terms of condition says it should only reach there, then there could be a difference between your GST turnover and your books turnover. There's nothing wrong. All that we need to do is have a reconciliation statement explaining the difference. Again, advance receipt. I have received advance from customers for the purpose of rendering service. I will recognize the revenue only when the service is rendered to you. But GST says the minute you receive the advance, you need to put it into your GSTR1 and pay the tax on it. And therefore, there will again be a difference. This difference again can be reconciled, should be reconciled. In fact, when it comes to advance receipt, I'm a little more wary. I'm a little more wary than I am with the revenue recognition based on risk and reward being passed on. What happens in the case of advance receipt, or at least the practical issues that we have had in our firm, is quite a few of our small clients who are into job work or who are into rendering of services, mainly, receive advance, pay GST, but forget to raise an invoice when the job is over. Therefore, advance from customers at the end of the year, when we analyze, we find that quite a few of them, the job has been completed, but they've just not raised an invoice because they have already received the full amount at the time of the order. Therefore, once they've received the amount, they think there is no need. And it still goes on, even 3-4 years after GST has come up, 7 years now. And 3-4 years after it became a little more strict, people, because they do not have a proper accountant, still continue to be wavered of this. And we need to look at advance received at the year end. Does it actually correspond, connect up with the jobs done in April, May? Or does it also have an advance which the job was over in March, but bill was not raised and reported in the GST portal? That also is another issue which we need to look at. But advance received will certainly have contribute to the difference between turnover as per books and the turnover as per the GST portal. Now let's come to service contract or construction contracts, where revenue is recognized in the books on the basis of percentage of completion method, whereas under GST, as and when a progressive bill is raised, GST must be charged and disclosed as outward supply. There is a contract, contractor and contractee. There is a contract between them. According to the contract, as and when a milestone is reached, let's say this particular aspect is over, basement, the first floor, second floor, whatever. It need not necessarily be construction. It could be anything else also. On the achievement of a milestone, a bill is to be raised. The minute the contract says that a bill is raised, and whatever the value that they have agreed to in the contract, that's the value for which the bill is raised. This gets reported to GST. But is that the rate at which we will recognize it in the books? No. In the books, we will recognize it at the percentage of completion method. I'll just give you a small example. Let's say the contract value is 10 lakhs. The estimated cost of contract is 9 lakhs, which means I have a 1 lakh profit on that. Now, as far as GST is concerned, it is stage-wise billing. So, for the first stage is over, the amount to be billed as per the contract is 2.5 lakhs. And therefore, when the first stage is reached, 2.5 lakhs will be billed, GST on that will be collected and paid. But will I recognize 2.5 lakhs in my books as the revenue? Under the percentage of completion method, the amount I must recognize is the cost incurred till that date divided by the total cost into the value of contract. If I have spent 3 lakhs till that date, then what I should recognize in the books is 3 lakhs divided by 9 lakhs into 10 lakhs, which will be 3,33,333 and not 2,50,000. This is an issue wherever we have contract which runs into, it's not a simple contract which runs into days and there are milestones we achieved. there will be a difference because we'll be following percentage of completion method as per the accounting standards. Sorry, my throat is paining, so I am sipping something hot. Please bear with me. Even in a 10 lakh contract, we find that there can be a difference of about 80,000 rupees in recognition between books and the accounting and the GST portal. We need to be clear and careful about it. There can also be differences due to foreign exchange fluctuation. Revenue entities following Ind AS or entities following AS doesn't matter. If you look at AS 11 paragraph 10 or paragraph 22 of Ind AS, it says you need not, for all practical reasons, you need not have a rate for every day. You can have a rate, foreign exchange rate fixed for a week or a month, provided there's no major fluctuation in the foreign exchange market. So I export today. I will account it in my books as on the exchange rate prevailing today, which is going to be by a banker, or an average rate that I have computed and kept based on several sites which give me that. But for GST, is it the same exchange rate is to be adopted? No. As per the GST Act, the exchange rate to be adopted is the rate notified in the section 14 of the Customs Act. Now, how many of us are doing it? I don't know. But if you look at the Act, it says you have to go by the section 14 of the Customs Act. That rate is announced by the Government of India, by the Customs Department, once every 15 days. So in every month, every fortnight, the rate changes. Till then, for all the days in that fortnight, it is the same one rate that will apply. And it is that at that rate, if you look at a customs invoice or a customs bill of lading or anything, it will be that rate that it will adopt. That is not the rate at which I will be accounting, because I will be accounting at the rate that has been given to me by banker. There is bound to be a difference between these two. But please note, in the case of GST, only for goods exported, we need to go by the section 14 of the Customs Act. For export of services, the exchange rate is the same rate that we can adopt any rate, including the rate that we are adopting in books, we can go about it. Because of foreign exchange fluctuation or exchange differences, there could be a difference in GST turnover with my books turnover. Again, something which we need to be aware of. We need to have a reconciliation for it. Very important aspect is, have we done an analysis of turnover rate-wise to ensure correctness of GST liability? Why I am asking this is, HSN, the HSN is the same, but the rates may vary. We need to be clear that the correct rate has been applied to the to the product sold by our auditees, by the entities where we are auditing. The HSN code, especially when it is in 4 digits and not in 6 digits, can mislead us into thinking that he is following the same rate, whereas he should actually be following a different rate. Same HSN, 2 different rates. For example, 0402 is the HSN code for both skimmed milk powder and also condensed milk. But if you look at the 6-digit code, 0402.10 is for skimmed milk powder, which is at 5%. 0402.29 is for condensed milk, which is at 12%. Most of our clients are only using 4-digit. They are not using 6-digit. They have not even looked at what the rate is. They put the rate based on the purchase that they have made. In that purchase invoice, they have an HSN code and a rate. They think that is the gospel truth. It need not be. We need to look at it. We need to educate our clients. Similarly, 1511 deals with oil. 1511.1 is crude palm oil, which is at 5%. 1511.9 or 90 is refined palm oil, which is at 12%. That's a huge difference. If my client is dealing with 151190, but he's only charging 5%, whereas he should be charging 12%, the liability could be huge. We need to be very, very careful with HSN. In fact, I was surprised when I attended a seminar a couple of years back in Kerala. I think they had a regional conference on GST, where there was one speaker for 2 hours speaking only on HSN codes and its appropriateness. Till then, I thought it was just a code. It doesn't matter what code anybody puts in. There's nothing, no issue at all. But there is an issue. Let's take hotel rooms. Hotel rooms is 9963. 1. Less than 1,000 rupees, there is no GST. Between 1,000 rupees and 7,000 rupees or so, there is a GST of 12%. Beyond 7,000 or 7,500, then 18%. The code is still the same. There can be the same HSN code, there can be different GST rates. This is something which I really want all of us to appreciate, all of you to appreciate and understand that I must start looking at HSN codes. Because without looking at HSN codes, I cannot be sure whether the exchange rate, whether the rate that they have charged is right or wrong. I can give you several more examples. Footwear. Of course, today it is no longer valid. It was valid till about a year or a year and a half back. Footwear is taxed at 18%. However, if the maximum retail price of the same does not exceed 1,000, the rate will be 5%. It is an exemption given by the GST department, GST authorities. But if you look at the HSN code, even in the 6-digit, it will be the same. At least I gave you an example where the 6-digit code, you will find a difference. But in this case that I'm talking about, hotel room or your footwear that I'm talking about, the 6-digit code is also exactly the same. But because of a price variation, the rate varies. And I think we need to look at HSN code with a lot more seriousness than what we have looked at so far. A client of ours, when we were auditing a client of ours, they were giving job contracts to 2 different entities. The job was the same, the nature of the job was the same, the material supplied was the same, the work performed with those 2 entities was the same. One of them was charging 12%, the other was charging 18%. The HSN code that they were using is 998898. Both of them use the same HSN code. So the client came to us asking, why is it that 2 people to whom I give job work are charging me different rates with the same HSN code? Then we did an analysis. We gave them an opinion. They wanted an opinion from us. The 12% rate is right. The 18% rate was wrong. But both of them figure in that schedule. What happens is under 998898, there are various services listed. Class ID, services way of job work other than 1A, 1B, 1C. So 1D talks about job work. Fourth, manufacturing services and physical inputs owned by others other than 1A, 1B, 1C is what has been given there. Then we read through a clarification given by the CBIC explaining why this is. They said as long as the job work is performed on goods owned by a GST registered person, it is 12%. When he does the same job work on goods owned by a non-registered GST person, it will amount to manufacture and therefore 18%. Look at the subtle differences in HSN code and rates. And this is something which I certainly want to highlight. Because we do not, at least in my office, I found it very difficult to get my article clerks and apprentices to look at the HSN code. We are still evolving. Since we are all members who are gathered here, it's easier for it to understand the nuances of what can go wrong. In fact, this lady speaker who was talking about who I heard 2 years ago, she will tell you several more examples of differences between puppets and applams, between a baked item and a non-baked item, and so on and so forth. So let us definitely look at HSN codes, see what it is, and then try and see whether the rates charged are correct. Because it's an undercharged rate. If they charge 18%, where they should charge 12%, collected and paid, there's no problem. But if they charge only 12%, they should charge 18%. There is an additional liability that is going to come in. Do we have to make provision for it in the books? If we don't make a provision, will it affect the true and fair view of the books? If I do make a provision, can I collect it from the person to whom I sold? If I'm not able to collect it, should I have to debit my rates and taxes? Does the client have to pay for it? I mean, bear the cost. These are questions that will pop up. So please do look at HSN codes. Discount amount. Let's move on to discount amount. There is a discount is disclosed in the invoice. GST will not be applicable because there is a trade discount. The value of the product is 1,000 rupees. So I in my invoice, I say 1,000 less 10% discount, 900 or 900 charge. Whether I show it in the invoice or not, the transaction value is only 900 rupees. And therefore, the GST will be only on the 900 rupees. The fact that I've shown it, it amounts to a trade discount. Trade discount, there is no problem. Let's say the invoice carries a remark and it says 2% discount will be allowed if paid within 30 days. Now, this amounts to a cash discount. I'm sure all of us are aware of the difference between trade discount and cash discount. While trade discount is not recorded in the books, cash discount gets recorded in the books. So when the invoice carries that, and if the payment is made within 30 days, a credit note has to be passed. So if the taxable value is 10,000 rupees, GST at 18%, 1,800, the bill value will be 11,800. 2% of 10,000 is what I have to pass a credit note now. Credit note for 2% will amount to 200, plus 36 rupees being 18% on 200 GST is what I will pass a credit note for. But if the invoice did not carry that remark, the credit note will only be for 200 and not for the 36. Am I clear about this? In other words, there should be a pre-existing agreement between the seller and the buyer as far as the discount is concerned. This you can understand better if we give you a larger example. There are several TV manufacturers, washing machine manufacturers, or any of the white goods manufacturers. They enter into a contract with their wholesalers and retailers, mainly with their wholesalers, where they say, and the wholesalers in turn will enter into a contract with the retailers, where they say, we will supply, let's say, this fridge at X price, which is a 30% discount to the list price. However, if your offtake is more than 50,000 units in a year, we will give you another 10% discount. This agreement is entered into at the beginning of the year and documented. If this agreement is not there, the discount that is passed on at the year end, because only at the year end you will know whether they are entitled to discount or not. The discount that is passed on to the year end, in the absence of the agreement, there can be no GST element at all. But if this agreement exists, then the GST can be passed on. Otherwise, it cannot be passed on. Therefore, a pre-sale agreement should be available, and the discount should be capable of being linked to specific invoices, which is possible because after all, the number is sold is what it is. Every invoice will have the number of the product of refrigerator. Let's take the number of refrigerators sold, and the total is counted. Therefore, it will definitely be possible to link it to specific invoices, and only when this condition is satisfied will they be able to pass on the GST. Otherwise, they will not be able to pass on. Has this been done in the cases that you are seeing? Are they in the habit of giving discounts? If they are giving discounts, is it this way it is getting accounted? These are things that we can see. Normally, in the pre-GST era, I did not look at these things as closely as I am looking at it today, because again, at the sake of being repetitive and boring, I always believe that GST has an impact on literally every item in the GL. There is no line item in the GL or the financial statement that does not have a GST impact. Moving on to scrap sales. Whether GST has been charged on scrap. I had a funny case in one of my clients' office last year. They had almost a ton of scrap. It consists of rubber scrap and also paper scrap, cardboard paper scrap. Now, what are the exact amount of paper scrap? What are the exact amount of rubber scrap? We were not able to find out. The rate to be charged, if you look at it, is for rubber scrap, it is 18%. But for paper scrap, it's only 5%. How do you reconcile this? Does your clients have scrap like this? Are they charging scrap? Are they charging GST on scrap? It will be an as-is where is condition. Most often, scrap is sold on an as-is where is condition, which can contain scrap of different combination. Electronic scrap, electrical scrap, rubber scrap, metal scrap, and things like this. Each of them are different rate. Thankfully, most of them are 18%. Some of them are 5%. Therefore, is it possible to differentiate? Or do you take a safe way and say, I'm charging 18% of the entire thing, collected and paid? I cannot segregate whether how many kilograms of rubber or paper is there in the 1,000 kilograms of scrap that I'm selling. I would rather bear that, even if the buyer is not willing to take, I will bear it. That's a management decision to be taken. But tomorrow, the department can say you have sold paper scrap and rubber scrap, but you charge only 5%, whereas you should have charged 18%. So be very careful, even with regard to scrap sales. In the pre-GST era, whenever I looked at sale of profit or loss on sale of fixed assets, a line item in the profit and loss account, I would look at the PPA schedule, fixed asset schedule, the property plant equipment schedule, to see whether the amount has been removed from the cross block, the accumulated depreciation has been removed from the depreciation block, and whether the profit and loss has been properly computed and given and disclosed in the financials. I will also probably look at the cash flow statement to find out whether it has been properly recorded there. But in the GST regime, I think I would also like to check the GST liability. I don't finish my audit unless I have checked the GST liability in the sale of fixed assets, because the computation of the GST liability in the sale of fixed assets is not very straightforward. In case the entity has availed ITC on the GST charge on the capital assets at the time of purchasing, if they avail ITC, then it is not a very straightforward case. Am I clear on what I'm saying? If they have purchased the machinery and have not taken ITC, capitalize it like that, and they are selling it, there is no problem. On the transaction value, we will apply the GST. But if they have purchased the machinery, claimed ITC, and sold it within a period of 5 years from the date of purchase, then the way the GST liability should be calculated is slightly different. You can see it in the bottom of your screen. In case where ITC has been availed and the asset is sold within 5 years, the GST payable will be the higher of A, the sale consideration into the applicable rate, and B, the reversal of proportional ITC claim. Let's look at an example in the next slide to understand this even better. The cost of the capital asset is 10 lakhs. The ITC claimed is 1,80,000. The maximum life of the asset as per GST rules is 5 years. You might use it for 3 years or you might use it for 10 years. Your engineers might say the life of the asset for us is only 3 or 4 years. But as far as GST as the law is concerned, they have said the maximum life of the asset will be 5 years. And that's what we have to go by. So it's 5 years. The asset is sold after 3 years for a fee of 3,25,000 rupees. Now, there is an ITC that has to be reversed. What are the ITC that should be reversed? The unutilized period in the 5 years, ITC should be reversed. Out of 5 years, 3 years is over, which means 2 years is left. The ITC that we claimed is 1,80,000 for 16 months. So 1,80,000 divided by 60 into 24 months, which is the unexpired period, will amount to 72,000 rupees. The sale price that has been fixed between the buyer and the seller is 3,25,000 rupees, on which 18% rate comes to only 58,500 rupees. The higher of the two is what will be the GST liability. So they should have actually paid 72,000 rupees, not 58,000. 58,500. Now look at this. The difference between 72,000 and 58,500, which will be 13,500 rupees, will the buyer of the machinery pay? He won't. Because he will say, look, we have entered an agreement. 3,25,000 is the price I'm going to pay. On that, you charge me 18%, 28%, whatever the tax rate says, I will pay that. But I am not going to pay you for your reversal. To that extent, this difference might have to be borne by the seller. Unless he is aware of it already and has inbuilt it into the sale cost, into the sale price that he has fixed with the buyer, he will have to bear this. I have to get probably debited rates and taxes, and amount has to be paid. Every audit that we audit will have some sale of fixed assets during the year. We need to look at it. If they are pre-GST purchases, there is no issue. If they are post-GST purchases and sold after 5 years, no issue. But if there are post-GST purchases and sold within 5 years, which can happen in many cases, especially in recent times, we find furniture being changed once in 3 years or 4 years, laptops being changed, computers being changed, even some machinery, because the machinery is no longer worth it. There are more sophisticated machinery that has come in. Therefore, they get rid of this. In all these cases, if they are sold within 5 years, this is the calculation that we have to go by. And to that extent, we need to check this thoroughly. I'm the quality review partner in my firm. I have found a mistake in literally every second financial statement that I review, which have all been audited, looked at by the respective partners before it comes to me for a review. There I found these mistakes. So this is a mistake which is a very common error which can occur very easily. Let us look at that and see whether we can avoid this. Because this can have actually an effect of tax payment, which we had failed to, which the auditor had failed to pay, we might have to make a provision for it, along with interest. Assume it had been sold in the month of last year, June. For 8 months, 10 months, interest also we have to provide. It can be significant. It can affect the true and fair view. We need to be careful here. Now, what about cars? When we sell cars, is it the same way? No, it is not the same way. Cars, we would not have claimed ITC. Therefore, this example is of no use to them for vehicles sold. There is a circular number 9/2018 IGST rate dated 25/1/2018 that talks about the way GST should be charged on the sale of a car, on the sale of a motor vehicle with engine capacity of more than 1200 cc and length of more than 4000 millimeters. What they have stated in the circular is very, very simple. They say, look at the return on value as per the books of accounts. You have a car, you have a return on value of the car in the books of accounts. Take that figure. Look at what is the return on value in the income tax statement. Not the book depreciation statement, but in the income tax depreciation statement, what is the same? Compare the sale consideration and the return on value as per Income Tax Act. If there is a profit, on the profit element, you will charge GST. If it is a loss, there is no GST. Are our auditees so knowledgeable that they would have done this properly? Did they consult us before selling it? They may not have consulted us. If there is a sale of a vehicle, please look at it. The sale value fixed and the return on value as per the income tax depreciation statement that we file in our 3CD. If the sale consideration is more than that, there is a profit. On that profit element, a GST should be charged. Let us say the return on value is 1 lakh and it is sold for 1,30,000. On the 30,000 rupees alone, GST is charged. But if it is sold for 90,000 rupees, no GST. This circular is 9/2018, IGST rate dated 25/1/2018. Look at it. Because today, whatever they change or not, whether they pay audit fees or not, most clients keep changing their car once in 2 years. They sell one car and buy a new car. And all these car dealers will come up with exchange your car, give you your old car, take a new car, therefore that will be there. Has this accounting been done correctly? That is something which I'm sure there must be cases in all the auditors that you're auditing. To look at it, and let us be sure that we have looked at it, and we have not, if there is a under provisioning, underpayment of GST, let us ensure that the provision is made in the books of account before we sign off. In my example, I'm talking about a car being sold for 1 lakh. Today, just yesterday, when I was reviewing the financial statement, a car was purchased for 70 lakhs 2 years back, was sold for 40 lakhs by the client, and is gone for another new car. In such cases, the amount could be significant. If they only charge it in the transaction price or they charge it in something else other than what has been said in the act, amount could be significant. Either they could be overpaying or underpaying. Whichever the case it is, cause for activate. If they overpay, there's nothing we can do about it. But if they underpaid, we need to provide for it, along with interest from the rate of sale. Reconcile the ITC claim on expenses with amounts debit to the profit and loss account. Easier said than done. Clause 44 of Tax Audit report deals with this. Institute has very clearly stated, if you can't do this correctly, give a disclaimer. Giving a disclaimer is easy, but I think we need to do something and satisfy ourselves that we have done at least 50 to 60% of what data that needs to be put in clause 44 is available before we can, and though that is right, and before we can also think of a disclaimer. The reconciling of ITC, the expenses debit to profit and loss account, is not a straightforward exercise at all. We could have several situations where recoveries made are credited to the same expense account. The nomenclature used in the profit and loss account may not prima facie trigger a GST liability. In fact, it won't be out of place to mention that under the GST regime, the responsibility of the auditor has increased manifold, and one will have to go through each line item in the profit and loss account with a fine-tooth comb. I'll use an example. Recoveries made from staff for transport, canteen charges are subject to GST. Thus, while auditing payroll, if you find that there are deductions other than the normal PF, ESA, profession tax, my antenna shoots up. Immediately, my antenna will shoot up and I say, okay, what are these other recoveries that they're making from the payroll? I am okay as long as they're only recovering PF, ESA, profession tax, or any of the statutory dues payable by the employee. Income tax, all that I have no problem. But the minute they say transport charges, canteen charges, some other charges, I am put on an alert. I would like to look at whether those recoveries that they're making, is there a GST component to it? If these items that they have recovered has been in the credit side of the P&L, as recovery for transport charges, recovery for canteen charges, whatever, at least then, while reviewing the financial statement, I would be in a position to locate it. But these recoveries would have been debited to the staff welfare account or the transport account. And therefore, unless I look at that software and that staff welfare account and look at the debits and credits in the account, I might not even be aware that recoveries have been made. And that's why I keep telling my assistants and my managers that you need to not just look at the trial balance, but you need to drill down into every ledger in the accounting software. The minute you find a credit item in a ledger account which is normally only debit, look at it. And if the credit is coming in every month in a pattern, please look at it. What is it? Why is it there? Is there a GST impact on it? Today, netting off certain expenses and income and presenting is a way which is not frowned upon. And I agree about it. I am recovering something towards the transport cost. I bear 50% of the transport cost. The employees bear 50% transport. I am recovering it. Why should I show that as my income? It is not my income. It is only a recovery. Therefore, it will go to my expense account. It will get netted off. Only the balance expense that I have borne will come to the expense of the P&L. Fine. But as an auditor, I am worried if you net off. Because if you net off, I might miss out the GST impact on it. So please look at it. Again, is there a GST or notice pay? Much debated question in the country. Previously, under the Service Tax Act, it was not. There were two cases, both in favor of the assessee, that it is not liable. Even now, under the GST regime also, there have been two cases. Gujarat State Fertilizer and Chemicals Limited. Commissioner of Appeals has said there is no GST on notice pay. HCL, Learning Systems, SETSAT case. Again, they've said it's not there. But I, for one, believe the controversy has not been put to rest. Even today, the dispute keeps on going, whether it is recorded or not. In fact, to be, just as more of a curiosity, a couple of days back, a day or two back, while preparing for this webinar, I logged into a ICAA chat GPT, went to the indirect access portal, indirect access chat GPT of the Institute of Chartered Accountants of India, and posed this question. Is notice pay subject to GST? It says it's a very hotly debated topic. It may be subject to GST depending on the contract between the employer and the employee. I'm not saying that the opinion of the Institute of Chartered Accountants of India is, after all, artificial intelligence is giving you this, but we need to be aware that even that could be subject to. There are enough articles written about it. Some of the experts have taken a stand that depending on the employer-employee contract, it may be chargeable. So if I was doing the audit of a company where there is a huge amount of notice pay has been recovered, not paid, recovered from the employee who left because not serving the notice period, I would certainly not want to sign the audit report and sign the financials until I had an expert opinion on whether what they have done is right or should they have charged the GST on this. Because they are recovering, they are receiving the money. So should they have charged GST and paid GST on this? There are several issues like this which keep cropping up in every ledger account. We need to be aware, even if we are not experts in it, we need to be aware that these are cases that can come up, and then look at the whole thing in a more holistic way than what we have looked at in the past. You are doing the audit of a corporate or a partnership firm, and you come across a line item called sponsorship fees. This payment is liable to RCM. And one needs to check if the liability has been discharged. The problem is, if they had set sponsorship fee in their trial balance or in the ledger, if they call it sponsorship fee, even if I'm not very well versed in GST. I know the sponsorship fee is subject to RCM and I would look at it. But they would not have called it sponsorship fee at all. They would have paid money for a sponsor towards sponsorship fee and debited to a ledger account called marketing expenses. And under marketing expenses, unless they did it out, I will do. So today what I have done is I have got a checklist. The minute we start the audit, we have you sponsored any exhibitions, participated in any exhibitions, events, so on, so forth last year? If they say yes, please show us those invoices. If they have sponsorship fee, I will pick it up for RCM. I think as days go by, we need to use artificial intelligence and also our intelligence and start building checklists for things like this. How will I know that they have paid sponsorship fee unless they tell me? The plethora of information in their ledger accounts. They will call it advertisement charges. They will call it sales promotional expenses. They will say product enhancement expenses. All sorts of new terminology is coming in. When I was a student of the CA course after finishing economics in college, I was only used to the word sundry debtors and sundry creditors. Today, those nomenclature is no longer valid. We're talking about receivables and payables. And therefore, even for a sponsorship fee, your client might have come up with a completely new terminology which might put in the ledger. You need to understand what is the nature of that expense. By just looking at the ledger end, we cannot come to a conclusion at all. We need to ask them, what is this? And then see whether there's an RCM liability on it. In Schedule 3 of the Companies Act, you are allowed to club various expenses which are less than 1% of turnover or 1 lakh, whichever is higher. So lots of things get clubbed into it. And we have one line item. Now, we will put ourselves at risk if we do not look at the composition of that line item to find out. Again, very honestly, last year, we looked at one of them and found something like 4.5 lakhs legal fees, which is less than 1%, and therefore they had clubbed it. Nothing wrong with what they did. But my people who did the audit should have found that out. There was a legal fee. After all, when you looked at TDS paid, you found that they have paid TDS on legal charges. Should it not have struck you immediately? Have they paid GST under RCM? The senior article who did the audit, when I questioned him, he said, sir, it did not strike me. I mean, I'm not blaming him, but it should have struck him. So again, add one more question to the checklist. Have you paid in legal fees during the year? Have you paid in lawyer money? Because legal fees need not get debited only to legal charges. It can get debited to various ends of professional charges. It can go to professional charges. And therefore, and sometimes you filed a case against a buyer or anybody for that matter, and you say all the legal expenses will record from you. So in order to recover it, they'll debit there and keep it. And if they maintain a memorandum account, it is all right. There are cases like this that can happen. So when I'm looking at TDS under the Income Tax Act and whether they've been paid properly, I will also, when I look at my mind should get triggered. Some of these things are subject to RCM. Let me look at RCM. Because again and again, and I keep repeating, there will be GST in literally everything. One case just a week back, a partner of mine was talking to me. Private placement of shares has been arranged by a financial consultant in a company. So he has been paid a commission. That amount needs to be written off. What do we do about it? So I looked at all the papers and I found that there was a difference between the amount in the account, in the ledger, vis-a-vis the invoice. Whatever GST had charged, that they had taken to ITC, which they cannot. It's a capital thing, not for the purpose of furtherance of business, and therefore it should be disallowed under Income Tax Act, also under GST. In my opinion, it should not be claimed. So even a thing like share capital, the expenses incurred to increase the share capital, the expenses paid for consultants to private placement of shares, their bills, is there a GST component? Can I claim ITC on it? I am not again saying that I am right in saying that you cannot claim ITC. All I am saying is there is something which we need to look at. I may take a stand different from what you take. I am sure that in income tax, Supreme Court has said you cannot claim that as an expense, therefore it will be disallowed. But in GST, no set clause still there. Can I take it? If I'm not sure about it, can I ask somebody else? Can I get an opinion? Look at things like that, because every element have a Every line item has a GST element. GST TDS. Unlike income tax TDS, which is to be done at the time of credit to the account or payment, which was earlier, in the case of GST TDS, it is to be accounted only when the bill is paid by the buyer, and he has time till the next month 10th to file the necessary forms for it. But if your client is supplying government companies with a turnover of more than 2.5 lakhs for that particular entity, they are bound to direct TDS on GST. See whether TDS has been directed. Look at the portal. Ask your client to look at the portal. File the necessary form. The minute you file the necessary form, it comes automatically. The amount comes into the cash ledger. See whether that has been done. You have filed a claim for refund. Your client has filed a claim for refund. Let's say like a claim was filed for 1 lakh on exports or inverted duty structure or whatever the reason for the refund. Only 97,000 rupees came. 3,000 did not come because they said it is ineligible for refund. What has your client done with the 3,000 rupees? Have they taken it to rates and taxes, or they have taken it back to ITC? In my opinion, if it is not eligible for refund, what is the point in taking it to this thing again? It will not get allowed next time also. You got to take it to rates and taxes and write it off in the P&L. Has it been done? Those things are something we can look at. As any financial statement that we look at, we normally do an aging analysis for receivables. Even though for non-corporate it is not mandated, Companies Act 1952 itself mandated aging analysis of debtors. And Companies Act 2014 is also continued with it. We would still do, even for non-corporate, we will do an aging analysis of debtors or receivables. Because if there is anything more than 3 years that has been pending for a long time, as auditors, we are expected to check whether the money will come. If not, a provision has to be made for it, and we would recommend a provision which the client will go ahead with. But till GST came in, I was not very keen on doing an aging analysis of payables because it doesn't matter to me. If they have not paid for 3 years, there will be no claim. At best, it is only an income to the client. We show it in the P&L as credits no longer required, write it back. But today, under the GST regime, an aging analysis of payables is extremely important. Because if a bill has not been paid for more than 180 days, the ITC availed at the time when you accounted for the bill has to be reversed along with interest. And you can claim it again only when the amount is paid. This is not to be done as a year-end exercise at all. It should be done as a continuous exercise throughout the year. Does the auditee have a system where if a bill is beyond 180 days, on the 181st day, the ITC claim of the bill should automatically get reversed and it should be claimed again when the bill is paid. I don't think any of my clients have that kind of an automatic system, except maybe 2 or 3 big clients they have built into the software. And they don't make a delay like this of 180 days because they're very well aware of the 45 days for MSME and they don't want to get caught in the MSME Act or pay interest, and therefore they ensure that the payment is made within 45 days. But there are several small clients of mine, medium-sized and small clients of mine. If I tell them, sir, you cannot take ITC if the bill is more than 180 days, you have to reverse it, nobody wants to listen. But as auditors, I think we should make an effort to find out what is the amount of ITC that's to be reversed. If the amount is significant, can I ignore it and pass and finalize the audit? The amount could be significant. Especially if you look at the interest that will come on this ITC to be reversed. It can be claimed again. I'm not saying it can't be claimed again, but have we looked at it? At least at the balance of the year end, the trade payable to the year end balance. There are 2 reasons why you have to look. 1 for 45 days for your 43BGH, 43BH, and 2 for ITC reversal. More than 100 days, ITC is to be reversed. Please look at it. Analyze export receivables on account of supply of services. Supply of goods export, no problem. Supply of services, you have let's say you sent it somewhere on February 2023 on export of services. On 31/3/2004, the amount still has not been received. Some consultancy was done to somebody in Germany, you raised the bill for 5 lakh rupees. LUT was filed, export of services, no tax. But the amount has not been received as of 31/3/2024 when you are auditing. You ask them if the money has not come, they say money has still not come, sir, but it will come. In 6 months' time, it will come. There's no need to make a provision. I am happy with the answer. because after all, it's still not 3 years old, it's not long pending, it will come and they've got correspondence, email correspondence, which they show me, fine. But what about GST? GST Act says, in a case money does not come within 1 year, you will pay tax on that amount as outward supply along with it from the date of invoice. Once the money comes in 3 months later or 4 months later or 1 year later, you can claim a refund provided it is within the time frame in which you have to claim the refund. These are things which a GST officer or a GST inspector will be able to look at easily from your financial statements. At least there's 180 days trade payables, you'll have to come to your office, look at the ledger, find out. But these are things which are available. Foreign exchange, earnings in foreign exchange by sale of services. Those are things which you can correlate. So again, please check. You should check whether the IT is reversed and also check whether it has been availed subsequently when either the payable, when the trade payable credit has been paid or when the money has been recovered from the service provider abroad. I mean, from the supplier, from the recipient of the service provider abroad. Now, how do we set it off? Status of long pending refund claims, please look at the portal. See whether they are pending or they have been rejected. If they are rejected, see what happens when I make a refund claim. I make a refund claim for 1 lakh rupees. The minute I make a refund claim for 1 lakh rupees, the portal will automatically debit my credit ledger. Take the money. Have I passed that entry in the books of accounts? The accountant should have passed it. He should have taken it away from ITC and kept it in an account called refund receivable account. If he does not do it, next month they'll be under the impression that ITC is available. ITC might not be available. You might have to pay tax. That is one aspect of it. But the fact remains that on the day on which you file the refund claim, an entry should also be passed in the books of accounts, taking it from ITC, crediting ITC and debiting refund receivable. Both are current assets, no doubts about it. But there is a difference in the nomenclature of the two accounts. One is receivable, the other is an ITC, which I can utilize. If it gets rejected, you should reverse it. Or if it gets passed for a smaller amount, again there's an entry to be passed. Has those things been done correctly? Where should the GST related figures be disclosed the financials? Again, I'm going with AS 22. If it can be netted off and show it as either in the debit side or credit side based on where it is, whether it's a credit balance or debit balance. But otherwise, if it is not possible to net it off, for example, you could have multiple entries. You could have a GST in, payable in Karnataka, but I have ITC in Andhra, which cannot be net off, so you have to show it only different. Rahul, how much time do I have, Rahul? 40 minutes, no problem. I can go until 5 o'clock, right? 4:45, 4:50?
Till 4:45, sir. 4:45, we'll have a Q&A for 5-10 minutes.
Okay, fine.
4:45, 4:50. We have
right.
5-10 minutes.
Yeah, it's now 4:20, another half an hour, no problem. Now, to claim ITC, there are conditions that need to be fulfilled. Check whether the goods and services have been received. Check whether the taxable invoice or the debit note issued by the supplier is also available. Claiming of ITC without satisfying both the conditions will result in incorrect ITC claim. Again, I'll come back to the same example. A company in Chennai transferred goods to its own branch in Hyderabad. Cross charge, you have to charge GST on that also, distinct person, you have to charge it. It was transferred on the 29th of January. Goods reached there to Hyderabad only on the 4th of February. But tally, if it's all, the head office, branch office are all interlinked, the minute an entry is passed here, the entry is also passed there. You can't do that. You are trying to claim an ITC which is not legally claimable because the goods have still not reached you. These are things which will come out. If they come for an audit, it will come out. Till then, there's no problem. You can get away with it. But when the GST people land for an audit in your office, in the office of your auditing, these things they can look at. Because of computerization, none of these facts can be changed. None of these things can be changed. The date on which the lorry left the country left a place is available. The date when it reached time when it reaches, all computers available. So how can you claim ITC? Although it is there, it will come in your 2A, 2B and all that. That's a different matter. But have you received the goods? Only if you receive the goods or services, you can claim. Things like this, at least if not on a monthly basis, the year end, at least we as auditors need to look at it and see that it's not paid. Because invariably what happens is the accountants, I was talking to a couple of accountants, so why are you claiming this when you know the goods have not reached? It's a cash flow problem, sir. We don't have money. We need to claim the ITC. I know that the goods have not reached me. It is still in transit. I have to claim ITC only after that. But my director or my partner or my proprietor says, claim. It has come in 2A, claim it. But the goods have not come to you. At least at the year end, I think we need to look at these things. If not on a monthly basis, I have a system built in for monthly basis. Very good. If we are unable to build a system, and if they are not willing to build a system, at least the year end balances we should look at. Coming to property, plant and equipment of fixed assets as we knew it in those days. Look at these three policies of three leading companies in India. One of them says it is accounted as stated cost of acquisition, less accumulated depreciation. The other says it is cost of acquisition, less accumulated depreciation, and cost includes purchase prices, taxes, and duties. The third says property, plant and stated acquisition cost net of GST credits. From a reading of these three accounting policy, I am able to come to the conclusion the third company says that they are claiming ITC on capital goods. The other two companies, I believe they are not claiming ITC on capital goods. Fine. Let them claim, let them not claim, that is their problem. But if I am drafting or I'm helping draft the accounting policy for an auditee of mine or a client of mine, I need to understand what they are doing first. If they want to claim ITC, then I need to ensure that it is mentioned that we are claiming the cost includes taxes other than those which are refundable by the taxing authority at the later date, or GST, which I'm going to claim as ITC, something like that line item should come in. If I blindly copy from a bigger company and put it in, it might be their policy, not my client's policy. So we need to be careful when you're framing a policy also. I just wanted to bring this to attention, although it might not have great relevance from a tax audit point of view. It could have, because if they've claimed ITC on capital purchase other than vehicles, but for the purpose of IT depreciation in your in class 18, if I remember right, of the tax audit report, if they've added the GST, then there's a problem. You can't do both. Either you claim ITC or you claim you capitalize it. You can't claim ITC and also capitalize it. That is not possible. ITC is generally not available on motor vehicles. ITC is not available on works contract when supplied for construction of a removable property. ITC not available on goods or services or both received by a taxable person for construction of a removable property. These are cases which are literally there in every client that we do. They would have purchased a vehicle. They will have some contract services. They will have some immovable property being constructed or a small room put up. In fact, this again was a very practical experience that we had last year. We're looking at reviewing the financials of a private limited company that exists for about 40 years. I saw additions to fixed assets. I saw the addition to building. I said, what is this that they have done? No, sir, they have constructed the audit team head lead said, sir, they have constructed a few more restrooms for their staff. Cost is not very heavy, for 10, 12 lakhs. I said, fine. Did they give it out of the contract? No, they have not given any works contract also. They purchased material, they hired labor, and they built it themselves. Fine. But on the material they purchased, have they claimed ITC? Yes, sir, they claimed it. I said, you can't, because the Act says you cannot. Whether you do self-construction or you do through works contract construction, the ITC for removable property you cannot claim. At the same time, if they have laid a big platform to erect one of their machinery, ITC is claimable. These are the subtle things that unfortunately we still haven't come to grips with when we are looking at accounts. At the time of finalizing accounts, these things escape our attention. We are still in the evolving stage as far as GST is concerned. Maybe another year or two later, we will be more grips. But even today, we need to be in grips, or even if we are not in complete grip of the situation, we need to list out some half a dozen to 1 dozen items which are critical and need to look at them more carefully and clearly during the course of our audit. In fact, care is also needed in the case of certain other plant and machinery. In general, lift and centralized air conditioners fixed within the structure of any civil construction are assumed to be an integral part of the civil structure. Hence, ITC cannot be avoided. This view was taken by the Karnataka Appellate Authority, Advanced Ruling Authority. Several rulings are available. So look at all those. Some of the rulings say, if the lift and air conditioner is mandatory for the building, as per the laws of that state or that city, then you can claim ITC. If it is not mandatory, it is not mandatory, therefore you can pay. Lots of disputes, lots of disagreements, lots of rulings. But look at those things, read, come to a conclusion, document it, and then go with your audit. Similarly, IT is not available not only on purchase of vehicle, but also on car insurance, car servicing, repairs and maintenance. I told my people, if you see any bills from an enterprise called, let's say, Kohinoor Motors, Hyundai Motors, Patel Motors, see whether IT will pay. But then today I'm coming across bills called pit stop. Now, how do you expect my article who's 19 years old or 20 years old to look at a bill called pit stop and come to the conclusion that it is servicing vehicles? Very difficult. Whereas you get notice from the department based on the HSN, they're sending you notice saying you claimed ITC on something which is ineligible. They go to the extent of saying any paint that I purchased only for repairs and maintenance. I could have used that paint to paint the cabinet boxes that are made as part of sales, part of manufacture. So we have to give a reply. When department is looking at HSN and trying to come to a conclusion that they are not eligible for ITC, we need to be equally vigilant and look at several things before we conclude that yes, ITC can be claimed in it, ITC cannot be claimed in it. These are things again where you cannot claim ITC. ITC also is not available in the following supply of goods or services: travel benefits extended to employees, food and beverages given to them, puja gifts distributed. You could have distributed a puja gifts to your own or Diwali gifts to your own staff or to your customers or to the public at large. Portion of it will get debited to staff welfare, portion of it will get debited to marketing expenses. How do you look at it? Gupta Bhavan sweet, probably a box would have been sent to my office also. And I would have enjoyed those sweets. But I need my duty to check whether they have claimed ITC on that or not. Because they are not, ITC is not allowed on all those. Health services, beauty treatment, of course. I think the last three lines in the slide, most of our clients don't give any of those benefits to any of their clients. But then I believe there are companies in India which also give health insurance, membership of club, health and fitness centers and all that. If you do have clients like that, please look at all those because ITC is not available in any of these things. Conveyance expenses. You are renting a cab. The company is renting a cab from an unregistered dealer or from a person who is giving a bill for 5% ITC. The company which has hired the cab will have to pay GST under RCM, and the amount paid is not, you cannot claim ITC on the liability discharged. Now, if I have a ledger account called cab hire expenses, I can look at it. But unfortunately, whatever is paid for the cab hire has been debited to either conveyance expenses or travel expenses or miscellaneous expenses. So I need to look at the vendor ledgers to find out what are the nature of services they rendered and look at that to see whether ITC has been availed, whether it has been availed or not, whether they are eligible to avail ITC or not, is something which I have to look not only at the expense ledger, but at the vendor ledger. In which case, the vendor registration will be done properly. If a vendor master tells me what are the goods they deal in, then it is easy. Do I have that information? Do I have the ability? Do I have the infrastructure? Questions that we need to ponder. But the fact remains that we need to ensure that these things are not claimed. IT is not claimed on any of these things. Travel and hotel accommodation. Invariably, every year, although it's now 7 years from the time GST came into existence, invariably every year, in some client or the other, we will find that the client has traveled to, let us say, Hyderabad or Karnataka or Bombay, and that hotel bill, SGST and CGST charged by the Karnataka hotel or the Andhra or the Hyderabad hotel or the Maharashtra hotel would have been claimed in the books of the client who visited. The accountant there is very clever. Well, no, not very clever. I would say he gives you an explanation. He said they wrongly charged SGST and CGST when they should have charged IGST. In the case of hotel rooms, it is only the place of where it is located. They will only charge local SGST and CGST. They can never give an IGST bill. These guys would have clubbed both and put it into IGST or put it into CGST and IGST, but I'm not eligible to claim it with the IGST and CGST and IGST of another state. I cannot claim it in Tamil Nadu. A common error we have found in most of our client cases. The error was there. Slowly, some of the clients are getting out of it. They are not claiming it. As long as they are staying in hotels in Tamil Nadu, they are allowed to claim. But if they are staying outside, they can't claim. They can account the expense, but they can't claim ATC. We have knocked cents into the head. Over every year, we've been knocking cents into the head. Some of them have changed, but I am sure there are still some people who continue to claim without being aware or wantonly. Whatever the reason, we need to be sure that it is done. Flight tickets. I book a flight ticket from here to Bangalore and back. IGST is charged. I can claim. I book a ticket to Bangalore and back. After reaching Bangalore, I decide to also fly to Mysore and buy a ticket. Karnataka state, the GST will be charged. I cannot claim it here in Tamil Nadu. Unless I have a place of business in Karnataka, I cannot claim it. Which means it has to go into my travel expenses without ITC being split and taken to ITC. Several problems, several issues. Every one of them has a problem. Let's look out for those things. Because it is IGST, if it is the IGST, we can claim. If it is SGST and CGST in the travel bills, we need to look at which state SGST and CGST. And if the entity that you are auditing is not registered in the state, it cannot be claimed. Let's move on to RCM, one of the most complex, important aspects of GST. It is the reverse charge mechanism, the very important aspect of GST law. Let none of us forget that. RCM should always be there in our mind. There are 8 goods on which tax is payable under RCM, like cashew nuts, tobacco, leaves, silk yarn, raw cotton, etc. I'm not going into that. There are about 16 services on which GST is payable under reverse charge. And I have listed out about 9 services which are common for most businesses to ensure that we are aware of them while conducting an audit. When we are doing an audit, let us keep at least these 9 services in mind, because in my opinion, my experience and my practical exposure for the last 40 years, these are 9 cases which will more or less be there in every client books. 1, transport freight charges, GTA. 2, legal charges. 3, arbitration fees. 4, sponsorship expenses. 5, project expenses, transfer of development rights, DR. I have told you the services are provided by whom and who is the recipient of service, RCM will apply. You don't need to bother about noting it down. I'm sure most of you already know this. Even otherwise, it will be available to you when I mail it to you. Lease rentals, payment to directors, you're paying sitting fees to your directors. GST component under RCM. Security services. Now, these last two items is what I wanted to really look at. Security services and conveyance expenses. In the previous one, GTA, most of us are clear about today. Legal charges and sponsorship fees might get missed out under RCM. Similarly, security services provided to any person other than a body corporate. So supply is rendered by any person other than a body corporate, and the recipient is the registered person located in the taxable territory. Then RCM will apply. Again, if the amount paid to the security service in the agency is accounted under a ledger head called security services, as an auditor, I will look at it. But it will be accounted under factory maintenance, head office maintenance, general expenses, any nomenclature they will use. Invariably, in our clients' case, we always found it under factory maintenance or office maintenance. Again, something which we need to look at. We need to be clear that they have a wide security service, which we know, because every time we enter the factory or the head office, there is this guard standing there and asking us to sign in the register. So we know that security services have been availed by them. All we need to do is ask them, have you claimed ITC on that or not? Or you paid, have you paid RCM on that or not? Only if they pay RCM can they claim ITC. Otherwise, they can't claim ITC. First, they should pay RCM. If they have not paid RCM, then you have to list out the entire amount along with interest and make a provision for it books, which could be huge because they've been employing 4 or 5 security guards for every month the last 12 months. Could be huge. Look at that. Similarly, conveyance expenses, renting a motor vehicle. Services has been rendered by any person. And if it is rendered to a body corporate, which means your auditee must be a company, they should pay under RCM. Have they done that? ITC and job workers. Another interesting thing. I can send the material. I am the person who is giving the job work. I can ask the materials to be delivered directly to my job worker. And once it reaches him, I can claim ITC on it. No problem. That has been allowed. Okay. Even when it need not reach me at all, it can go directly to him, I can pay it. Now, I have given raw material for him to work on. He has to return back to me within 1 year. If I have given him dies, jigs, or any capital goods for him to work on, it should be returned to me within 3 years. If it is not returned, what happens? If inputs are not returned within 1 year, then section 143.3 and 143.4 of the CGST Act kicks in. It says it will be treated as outward supply from the date of and the date of transaction will be the date of dispatch, original date of dispatch. So if you're doing the audit for 2024 and you find that some goods were sent to job work last February and they still haven't been received, then it will be counted as the outward supply and tax will be levied from last year at the transaction date, interest will be levied. In the case of capital goods given to them, it is 3 years. Something which most people do the job works. Most manufacturing units have some job work or the other being done. So again, something which is important for us to look at. Moving on to tax audit report. Clause 4, question 4, which talks about assessee is liable to pay indirect taxes. Please install it. Now the tax audit quality review board has stated that in this only GST number is mentioned, nothing else is mentioned. We will look at why other things should be mentioned. In my opinion, if you look at custom duty, I might have an import code. Should I mention it? Yes, I should mention it. Goods and service tax, no longer there. I am not paying under goods and service tax, therefore I will not do it. Excise duty, no longer applicable to me. I am not paying, therefore I don't have to restrict. But the tax audit quality review board has said, in your CARO report, you have stated that there are dues pending disputes in the case of excise, service tax and all that, which means you're still liable to pay tax under those acts and therefore you must give that number. We will look at that in a little more detail when we look at their observations itself. But for now, please list out whatever is applicable. Don't just give only the GST number. 18, depreciation schedule. Again, lots of comments have been made by URB. I have personally seen in my own office, the ITC has been claimed on capital goods, but has been added here in the income tax depreciation statement, which means the cost of machinery capitalized in the income tax statement is the cost plus GST, although in the books it has been capitalized X cost because it has been taken to ITC. That mistake can happen. Please see that the additions as per the PP schedule in the books of accounts jibes with the additions in the tax audit report. Any personal amount debited to profit and loss 21A clause, profit loss being the nature of capital personal. If you are disclosing any item here, look at whether ITC has been reversed on those things. Similarly, when you talk about quantitative particulars that you're giving in the last few clauses of the tax audit report, if you show something as wastage or lost, or I'll go to CARO. For those of you who are doing an audit of corporates, in CARO we talk about inventory, we talk about difference between book stock and physical stock, and whether it is material or not within 10% range. Even if it is a minor variation, and you're saying it is not significant, the fact that you're saying there was a discrepancy between book stock and physical stock, my view would be that there is definitely a GST component. You could have lost, the client must have lost it, broken, free samples, whatever. In any of the, in all these cases, the ITC availed on the number of items which are sold, which are lost, damaged, or given as free samples need to be reversed. So has that been done? Is something again which one needs to look into. Cross-charge has not been defined per se. Before going into cross-charge, we'll also look at taxation audit quality review board. I'm not going into the composition. I'll just try to look at this. Suo moto they can pick up on the basis of some criteria to the design of the board using a database available from nationally known sources, which means you and me can get picked up. Your tax audit report and my tax audit report can also get picked up because they're not talking about entity size, they're not talking about turnover size, they just talk about a criteria that they can decide. For example, if they decide that all retailers of a particular product this year will pick up. And if they say, look, we need to have a sample which is all over India, not just few states, then the chance of any one of our audit reports getting picked up for scrutiny is bright. With that in mind, let us look at the comments made by them. The review process is simple. I don't want to spend any time on it. It is done by a technical reviewer, and then it is done by the taxation review group, and then finally the taxation review board will look at it. I would urge all of you to look at whether you're qualified to be a technical reviewer, impanel yourself. All you need is 10 years of pre-qualified experience in direct tax or 5 years in indirect taxation. So please do it. Get yourself enrolled. You also get paid by the institute for doing this review. Many of the first item they mentioned, many of the tax audit report did not have the paragraph related to RC responsibility and tax audit, which is what I discussed in the first 10 minutes of my presentation. Please ensure that it is done. This is not so much from the point of view of the auditee, but so much from the point of view of the auditor. I always believe that we need to safeguard ourselves first and then only our clients, because nobody will save us unless if we don't save ourselves. No client will come to our rescue if there is a problem. We will go rushing to them, but they will not come to our rescue. From that point of view, I thought I should point this out, that we need to put these paragraphs in. Again, I also want to highlight that the board has laid a lot of emphasis on it, and therefore we need to do this. Second, they are talking about the address reported in this under this clause, where we ask you the address was different from the one mentioned in the annual report or register of the Ministry of Corporate Affairs. I think we need to be careful when we're doing this. The address to be mentioned is the same as it should be, has been communicated with the to the Income Tax Department for the assessment purpose, or in the case of branch, address of the branch unit should be given. For company, the address of the regional or register office should be given. In the case of the new SSC, the address should be that of the principal place of business. All these are not my opinion. They are all the guidance note issued by the Insurance Chartered Accountants of India. And I have always believed that if I stick to the guidance note given by the Insurance Chartered Accountants of India, even if there is a mistake, I can defend myself easily saying, look, I only followed what you told me to follow. I have not done anything outside what you have told me to follow. Therefore, if you are in doubt, please read the guidance note. What are the registration numbers that you must give? Then they ask you whether you are registered under which all indirect tax acts. If you read that the observation, they say, Caro, they have stated that these things are pending, excise duties are pending in case, disputed, undisputed, several things have been disclosed in Caro. But in your tax audit report, you have not mentioned those registration numbers at all. I am unable to understand the logic of why I should put it there, but the institute says you must put it. So please ensure that it is put there. Second observation they made is registration number and indirect tax law are based on SSV PAN, but that did not match. I fail to understand how that can happen, but obviously it has happened in some cases. Maybe it is a typographic error. Again, look at the name of the client, the PAN number, the GST number that we are mentioning. If it is on that basis that the portal is opening up, there is no problem. But if it is something which we are keying in and entering, please ensure there is no error at all there. Appropriate post mismatch was not found under clause 3 or clause 4. So look at all these things and be sure that they are correct. There are no errors at all in those things. Now, you are filing the audit report for a company. Under which clause are you filing? 44 ABA talks about turnover for business, ABB talks about turnover for profession and all that. What you should actually be filing for a company, the third provision of section 44 AB audited under any other law. But I believe lots of people have chosen 44 ABA or 44 ABB. That's what the Institute TAQRB observation is. So please select the correct drop down from the menu as whichever applies to you, that should be the one. So if the entity for which you are giving the tax audit report has already been audited under some other law, it should be the third provision of section 44AB and not any of the other ones there. Whether books of accounts have been prescribed under 44AA, we all say yes, and this sort of book that have been prescribed. But then, for companies, no books of accounts have been prescribed by 44AA. So the institute says, books of account to be maintained by companies and prescribed by some other act, not by section 44A, and therefore you must only report no there and not yes. Simple errors. We are all so used to writing yes, books of accounts have been prescribed and filling up the cash book, sales ledger, purchase, but institute says you should not do that. So please again look at that also. These are more to do with ICDS. I don't want to go into that. It's a subject by itself. I would only want to stretch on column clause 18, where they are saying the additions as per the financials and as per the clause 18 does not match. Date of purchase and date of put to use has been one date for all the items classified. Date of sale again has been one date on which all assets have been sold. These are all, in their opinion, not possible at all. And therefore, you need to be clear about all these things. Year-end adjustment increase. Moving on, we're coming to the last few slides of my presentation. A provision is made for services available from domestic vendors exclusive of GST. For example, you have taken the audit has taken place on rent. The bill will come only sometime on the 5th of April or 10th of April. On 31st of March, you will make a provision. You will make a provision exclusive of GST because ITC cannot be claimed without the invoice. Therefore, we will do it. But at the same time, you are availed a service from somebody abroad or even inside India on which GST is payable on RCM. For example, legal charges. A lawyer gives you a bill on the 20th of, you've given him a job and you're going to make a provision for the legal charges. You have to anyway pay the GST and RCM. Therefore, you have to, in my opinion, you have to pass an entry inclusive of GST. Ensure that provision is made for GST short paid during the year due to inadvertent error in rate, classification, calculation, along with interest thereon. Ensure reversal of ineligible ITC and creation of liability and interest. If these things are material, we could be in a problem. If they are not material, we might not be in a problem, but the client would say, why did you not tell me earlier? Why did you not put it in the books? Those kind of things also can happen. So at least let us brief the client. Look, you missed out. For example, if he has done 1 or 2 exports sometime in February, suddenly he gets an export order, he exports. LUT not filed. What is the impact? Because LUT has not been filed, can the department say you have to pay tax on the whole thing? Maybe that's a stand they will take. You might go on appeal and win. But the question is, have you made a note about it somewhere? Have you brought it to the attention of the auditing? Or have you made a liability? If you've made already a condemnation petition has been filed to file an LUT late and it will be rejected by the department, have you, as a matter of abundant caution, provided for liability because export has been made without payment of taxes, but LUT not filed? Again, an issue. In all these things, I think you need to have a considered opinion. You need to take a considered view, talk to experts, document it, and then finally take a stand. Moving on to cross-charge. It's not been defined in the Act, except it says a person who has obtained is required to obtain more than one registration. If he is required to obtain more than one registration, in respect of such registration, he will be treated as a distinct person for the purpose of this Act. Head office in Chennai, branch in Hyderabad, one branch in Bangalore. Obviously, there are 3 distinct persons. They are distinct person. There will be a cross-charge. That cross-charge cannot be avoided. It has to be there. So when goods are transported from branch to head office or branch to branch, there will be a GST. Now, what about common expenses? For example, let's take audit fee or human resources or IT services. A common bill is received by the head office for IT services rendered to the head office and the 2 branches. The split up has to be passed on by the head office to the 2 branches. They have to raise in turn an invoice where on a proportionate basis, ITC must be transferred to them also because the services have been used by that branch. Therefore, the ITC also belongs to that branch. Similar as to good transport from branch to head office, same thing also in services. Audit fee. I might raise a bill, raise an audit fee bill on the head office, but I might have actually sat in Karnataka doing the audit because the factory is there. The main activity is in Karnataka. I have done that. I come to Chennai, sit in the head office, finalize, and sign and give a audit report along with my audit bill to the head office. The head office in turn must pass on whatever portion of that audit fee to the factory in Karnataka. It has to be, that's what cross charge is all about. Has it been done? Section 15 of the CGST Act 28 lays down the methodology. Says, well, if it is not possible, you have to look at the open market value of the supply. Where open market value is unavailable, the value of supply of goods of similar nature, 110% of the cost of goods, any other reasonable method. So if I'm talking about, let's say, human resources, number of employees, can I split the amount of number of employees? If I'm talking about IT, can I do it in the basis of the number of machines available, laptops or computers available and services provided? When I'm talking about audit fee, can I look at it as a turnover? Karnataka turnover, Chennai turnover, and split it. Some basis I need to split it. This is cross charge. Has it been done? Today, I think the ISD also changes have been proposed in the Finance Bill, Finance Act. I think it's coming into effect from 1st October. Till then, there's not an issue. But after 1st October, ISD is becoming compulsory. So again, something which we need to be aware of. I won't finish an audit unless I've done the following reconciliation. Month-wise broad summary, drill down GSTR 3B and GSTR 1. Parameters for verification I've given there. I also do month-wise broad summary and drill down in case of discrepancy between 3B and 2B, 2A with books of accounts. Parameters of verification will be ITC of the particular financial year. ITC of the particular financial year claimed to the next financial year. ITC not yet claimed. ITC deferred. ITC lapsed. These things I do. If you look at the portal, these are something which are available in the portal. These are returns available in the portal. Almost 6 returns, all of which contain a plethora of information from what you have filed. And are there any discrepancies? I think I would like to look at these things along with the books of accounts to see. I've just listed out what is available there. For example, in this, if you see tax liability and IT summary, there's a shortfall in 1 month. Why is there a shortfall? If the shortfall continues in all the months, then is there a net shortfall? Do I have to do it? I don't have to. I have to do a thorough audit. But these things will come to my aid. So look at these statements which are available in the portal, and then compare them with your books. Ask somebody who's in charge of GST in the auditing office or in your team to see that there is a GST reconciliation statement ready before the tax audit is completed, so that your filing of 9 and 9C becomes easy. It should be a completely easy process. Once this is over, it should not take you any time because the entire GST reconciliation has been done even during the course of tax audit. That is the aim and objective. That should be the aim and objective. See, look at the differences. There are differences. Why is the difference coming? And if it's a continuing error, then we know where the problem is, we can check. And these are not things that my auditor has worked and given. These are things that the department has worked and given to me. Are we aware that there are several statements like this? Are we looking at these statements? Let's look at these statements to see whether we can use it to do a better audit of and take into consideration whether all the aspects of GST will be looked at. Is it possible for adjustments? Finally, the respect is to avoid errors. Do not have a liability which you missed out because of GST. Finish your GST. Finish, as I said 2 minutes back, you must be in a position to file 9 and 9C when you finish your GST audit, because it is tax audit, because you should have looked into all the GST angle also along with tax audit. After all, when we do a company audit or an audit, we take all the particulars required for GST for tax audit. Similarly, can we also have some more checklists to take all the particulars for GST compliance and GST impact? Can we see whether all these things attract a entry, attract a provision to be made? Have we made that? Because if we have not made it substantial, we have to only make it next year. You can't revise it. There's no option to revise. Any adjustment on account of GST audit should be adjusted subsequent period only. And if some of the liability has been taken as an expense because nobody is going to bear in goes to rates and taxes, it will be prior period expenses. Will the income tax department allow it? All those questions come in. Can you account for GST TDS bill rate made with return in another financial year? When should the GST TDS be accounted? It should be accounted only when it comes into your books, into the portal. Till then, you can't account for it. Only when they pay, they will pay TDS. And then only after you click on that, only will it come into your cash ledger there. And that's the date when you will account it and also in your books of accounts. Can you use GST TDS to pay RTM liability? Of course. It's your cash lying in your cash ledger. And therefore, you can definitely use it. Friends, it's been a great pleasure talking to all of you for this last 1.5 hours. I wish I'd been in a live seminar. I would have liked to interact with most of you. To conclude, I would only like to emphasize that knowledge of GST law and rules is a must for conducting audit of any enterprise. Forget that you're doing 9 and 9C. Even for a normal audit of any enterprise, knowledge of GST law and rules is important. You need not be an expert on it, but you certainly need to have GST law and rules knowledge. Reconciliation between figures as per books of accounts and GST returns should be done as far as possible, eliminating all differences before finalization reports. Auditing standards need to be followed, which I don't have to emphasize. Cross-verify figures between financials and all that. I don't see any reason why we should have been in a situation in the month of November when we are looking at 9 and 9C. Oh my God, I missed out to make a provision of 50,000 rupees on account of GST in the financials assigned in September. That's not a situation in which I would like to be, and that's not a situation in which any of us should be. So with that in mind, let us do an audit for the next 15 days, keeping in mind the 3 letters GST in our minds. Thank you very much for a very patient hearing. I hope you enjoyed my presentation as much as I enjoyed presenting it to you. Thank you.
Thank you. Thank you so much.
My email ID is here and my mobile number is also here. Any of you have any issues with regard to any auditing query or with the GST impact, please do write to me at the email ID. I promise you that in spite of the month of September being a very busy month, I will reply to you within about 24 hours from the time your mail hits my inbox. To the best of my knowledge, I will certainly answer all your questions. Thank you.
Thank you. Thank you so much, sir. The session was power-packed, filled with knowledge, touching all the aspects from covering, giving an overall view kind of thing, touching SS 700, financials, and each of the areas, what are the key aspects, what we should look from GST perspective, which will definitely be a value addition for all the participants who have joined this. So we have a couple, 2 or 3 questions. We'll just take it. Can we take this, sir?
Sure. Only thing is, let me see whether I can answer those questions. If I can answer those questions, I'll certainly answer those questions.
Sure, sure. So, okay, one general question is, to what extent I should look into GST aspects while doing tax audit?
Well, it's a very difficult question to answer. It will depend on the kind of business that your client is in and what kind of internal controls that your client has built into the software or into this thing. If let's say they are into exports, I might not really worry too much about looking at the GST compliance because there is no GST tax payable on outward supply if they are 100% export oriented. But there again, my focus will only be on RCM items. And whether the ITC they are accumulated in claim refund does not have any ineligible credits at all. But if they are not into export, where it's not, I won't say they're exempted supply, it's a zero rated supply. But if they are into several products, like let's say retail, I will certainly be focusing first on the HSN codes and the rates being correct. Because if the rates are correct, my outward supply and the outward liability is fixed. Then I will also spend a little time asking my people, at least in the first year of audit of that entity, to look at whether the inward purchases they make, whether the rate is charged correctly by their suppliers. Because I don't want them to charge a lower fee and a lower thing and get into trouble later. So the HSN codes, definitely I will look in. In fact, as I told earlier in the presentation, HSN code plays such a vital part. HSN code and RCM are literally the 2 bugbears of the GST regime. They are there, they are difficult, they are complex. In RCM, I forgot to mention one thing. If a registered person has taken a commercial building from an unregistered person he has to pay GST and RCM. So RCM is an area which I would certainly look at. If I'm sure that the rates that they have charged is correct, then my outward GST liability, I don't have anything to worry about. So I will ask them questions, leading questions in the checklist, where I will ask them about all areas where RCM is covered. And if I get an answer, because they are not aware of it, like I told you about sponsorship, they might not be aware of it at all. So from their answer, I will know where to look for these items and then go and look at it. Extent of check, typically, we are trying in our office to build a system where we start audit, let us say, in sometime in the month of February, because an interim audit starts for the 9 months audit, and then we continue. April, we take a break because of bank audits and several other things. But we try and see whether can we do GST audit along with the tax audit. It's difficult. We still haven't reached that place. But we definitely do a turnover reconciliation and IT reconciliation. We might not have looked into RCM so much, but turnover reconciliation and IT reconciliation, by and large, at least for all our major clients, we are able to complete it even at the time of filing the tax audit report. And that's the extent to which you should look for. Having said that, let me be very clear. The extent of check for GST is no less than the extent of check for any other law. In fact, in my opinion today, it should be priority number one. Because if it hits you, if a liability hits you from the department, it can be huge. And therefore, I would not want to belittle the impact of the extent of check that should be done for GST.
Thank you. Thank you for that. To summarize, sir would like to protect the liability which is upcoming to the client by just make sure that all your RCMs are paid. If any ineligible ITC is there, that is being capitalized in the books or hit to P&L account, so that you are not ending up paying tax on that again. Then the third aspect is, wherever the output tax is there, check on the rates. These three aspects, I know this is not the complete answer, but it is 80% of your job is like done, tick, tick. Okay. So we have one more question.
Rahul, just to add to this, let's take an example. I paid 1 lakh rupees to a lawyer. Like let's say sometime in last May 23rd, 1 lakh rupees is paid to a lawyer. 18% GST on that is 18,000 rupees I should have paid. If I notice it now and ask them to pay it, then the issue is different. At least only interest is a loss. Because I can claim the RTM underpaid, RTM paid at the ITC. I don't notice it. It comes to the notice of the department, let us say 1 year later. I can't claim the amount paid at the ITC also, because the date for claiming RTM would have been over. So the loss is not just the interest, but also the amount. That is why RTM takes such an important view, in my opinion.
Definitely, sir. Taking it forward, we have one more question, sir. Clause 27 of tax audit requires us to report data with respect to SENVAT. In the era of GST, should we give details of GST or should we leave it blank? That's the question.
think we should leave it blank.
Okay.
There's no reason why we should give them, because SENVAT is no longer there. They have specifically said SENVAT. We don't need to do it. Having said that, when I mail this presentation to both the associations, I will also let you know, give you a paragraph on this particular clause after going through the guidance note on tax audit report again. In fact, I'll make it part of my presentation if possible. Otherwise, I'll have a separate note for it so that the members can benefit from what is there.
Sir, one very interesting question has come. As a fraternity member, a person doing direct tax is, as we are moving into era of specialization where each person is taking each field. A question has come, if I'm doing only direct tax, okay, I have experience only in direct taxes and I want to look into that only, then how do I go about it? You can add it, please, definitely after this session. Like
very difficult, you know. Today it's actually going to be extremely difficult to practice as a sole proprietor or a two-partner firm because of the specialization that is required in various fields. Notices and circulars are being issued on a daily basis. How do I keep track of them? As an individual,
I think you need indirect tax partner.
You certainly need. You certainly need. Or you need to have your professional colleagues who will give you a guidance on at least the key aspects of it. I completely agree with you, Hitesh. Extremely difficult.
True. Okay, so we are on 5:04. I would just thank you, Ramesh sir, once again. I would like to take 1 minute to brief about KSCA organization. We are touching to 4,000 members as organization serving CA fraternity all around Karnataka and the adjoining states. We are conducting programs. These webinars will be regular. In a frequency of 2 months, we conduct 3 sessions, and it will be based on the different aspects which members face, the challenges in which you and me in our offices face. The topics will be that, and those topics will be addressed by the experts in our industry, helping us build our knowledge and practice. And the second type of programs are the offline programs, slightly advanced kind of thing, who want to capitalize on their practice. In the sense, one program, upcoming program is a GST courtroom series. It's a 4-week program, and a GST residential program, which is a 2-day residential programs. People from Kolkata, Maharashtra are coming and joining this program. It is just to give you an update. There are other committees who are working on, say, how do we use technology in audit in today's form. I hope all of these programs will add to your knowledge bucket, to your, when you are going and serving to the client, it will definitely be your value addition. Having said that, if you are being interested, if you want to be member of our organization, I would ask you to visit a website called www.kscaa.com, or you can reach out to any one of us. We can guide us taking it forward. I would like to hand it over to Sachin to carry out a vote of thanks for this wonderful session, which is conducted by CA Ramesh in association with Telangana and Andhra Pradesh Tax Bar Association.
Rahul,
Yes,
there is
Sachin.
one more question in the question answer session. There is one more question.
Okay. Okay. Please send the PPT. Okay. Since this. Sir, okay. This is again a practical question. They're saying since 9 and 9C form is not available on the portal, okay, when we are trying to finalize without knowing what are the figures which are auto-populated, like what will give us confidence in carrying out all of this compliance?
Okay. I'm not too sure about the working of the portal, but the 9 and 9C figures are going to get popular only from the GSTR 1 and 3B that you have filed. It's not going to get popular from anything else other than your GSTR 1 and your GSTR 3B. So let's take those figures as the base and prepare, if it is possible, now. Wait for them and see whether they are asking for anything more, and then look at it. But if, okay, forget all this. Forget G9, 9C, GSTR 1, 3B. If I have reconciled my turnover with that of the report on the portal, and if I've looked at the HSN and paid the correct liability which I've accounted for, then can there be an error? There cannot be an error. I'm talking about pure accounting. Similarly, RCM, we have covered all the aspects of RCM. Those 16 services that come under RCM, if you have looked at that, and out of which about 10 of them or 11 of them will not be applicable to us, only 4 or 5 will be applicable. If you have looked at those expenses, ask the client where are those expenses in the accountant. Cab hire, everybody would have. Where is it accounted? Have you paid RCM on that? If we are able to, split into smaller points and gather those data and keep it, we may still have missed out something. I'm not saying we would not have missed out anything. But the impact that we would have missed out would be very small. It might be negligible, immaterial, and after all, the entire auditing list on materiality. Therefore, we don't have to worry. That's why I gave an example where something serious gets missed out. The amount could be material, and forget we missing it out, true and fair view and all. The client will say, sir, if you had told me, I would have paid RCM last year. You are coming 2.5 years later, the GST department comes and tells me that RCM is not, and they're charging me an interest which is more than the amount of tax, which is what is happening. So we can actually add value to the client also by giving this. That's what I would look at. It's very difficult because the portal is not ready. Therefore, what exactly are they going to ask? But by and large, I think the figures that they asked for in the last year is the basis. There cannot be too much of a variation.
Definitely. So we are, by doing this exercise, we are reducing the margin of error. Say from 100%, we are bringing it down to 20%. As auditors, we know there will always be some flaw. But having overview and basic knowledge will help you to reduce that margin of error by drastically.
Absolutely.
Which will add value to your client.
In fact, that is the only thing that we work on, Rahul, because we do not want to be in a problem. We do not want somebody to sue us or some regulator to, make a complaint about our work to the institute. First, my safety, my client safety is next. I have learned that the hard way in the last 40 years of practice. So first I save myself and then the client. That's why I work at. That's probably the best way to work at, because if you have a problem, nobody will come to us. The client is today with you because for the fee you charge, you are giving him excellent service. If somebody gives a service slightly lesser than what you're saying, he'll go away. There's no loyalty. Those days are gone. So let's be practical. Let's look at our safety also when we try and help the client.
True. Now, having said that, I hand it over to Sachin to give vote of thanks.
Thank you, Rahul. Good evening.
Before you start your vote of thanks, my partner Sundarajan, I think he knows you and you know him. So he said, I will say a big hi to you.
Hi, sir. Good evening, everyone. I am delighted to express my sincere gratitude to all of you for joining for this insightful webinar. First and foremost, I would like to thank our speaker, CAS Ramesh, for taking up this need of the heart topic. Your expertise and knowledge on this complex topic is invaluable. With the practical examples you have shared and with the engaging and informative presentations, I'm sure it has benefited everyone in attendance. I would also like to acknowledge the efforts of our President of KSCAA, CA Vijaykumar M. Patel, and our dedicated office bearers whose leadership and guidance has been instrumental in making this webinar a success. Additionally, I wish to express my sincere appreciation to our office bearers of the Telangana and Andhra Pradesh Tax Bar Association for partnering with KSCAA in organizing this exceptional webinar. We look forward to many more collaborative endeavors that will benefit both our members. Finally, I thank each and every one of you for joining us in this webinar. Thank you all once again.
Thank you.
Sure, Sachin, we shall continue to partner these programs every month.
Yes, sir. Looking forward.
Definitely, sir. Looking forward to it.
Good one, Rahul.
Thank you, sir.
Thank you. Thank you,
Nice
everyone.
moderation. Nice moderation.
Hitesh, shall I mail it to you, Hitesh?
Yes, sir. Please.
Okay.
You send it to me. I'll circulate accordingly.
Okay. Thank you. Just give me half an hour's time. Go.
No issue, sir. Take your time.
Yes.
Thank you. Thank you so much.
Thank you.
Thanks, everybody. Thank you.
Thank you, Rahul. Thank you, Sachin.
Thank you. Bye, everyone. Have a great tax season, guys.